Okay, mate, family and friends, the RBA has put the cash rate up. In this video, I'm going to talk about how this directly affects you. So as you can see, they've put the cash rate up by 50 basis points. So now the new cash rate is 2.35%. Now the reason why they've done this is the board is committed to returning inflation to the 2 to 3% range. See, the issue is Australia's inflation is the highest it's ever been since the 1990s. And they're saying inflation is expected to peak later in the year. They're actually expecting CPI inflation to be nearly 8% by the end of 2022. It's not all doom and gloom, everyone. The green is the good stuff. The Australian economy is continuing to grow solid. Unemployment rate declined further in July to 3.4%. Guys, that's the lowest it's been in 50 years. So what I see here is actually huge potential if you're in the right mind frame. Now, let's talk about how this can affect you directly. So the average variable today is around that 3.9% mark. With 0.5% increase, we can expect the average variables to be around that 4.4% mark. Now let's see what that looks like in your bottom pocket. On an average loan of say $600,000, we have done the mathematics based on a 30-year P&I loan. It's about $250 a month more in interest. However, 600K loan is not the average these days. It's more like 1.2 million. So on 1.2 million, you can expect to be paying an extra $500 a month or $115 per week. So that's quite a lot of money you have to find. So the fixed rates are over here to our right. So 5 years is sitting at 5.29, with a 1 year similar to the variable. But let's do some numbers, right? So if you're 5.29% fixed for 5 years, minus 4.4%, it's going to cost you an extra 0.9% to fix in. Now, on a $1.2 million loan, it's going to cost you about $10,680 more to fix in. Historically, it's cheaper to be on the variable, but we understand fixing is something which gives you more security. It's like an insurance policy. So I'm going to call up Patrick right now, and let's see what's happening in the property market. Mate, thanks for taking my call. The cash rate has gone up by 0.5%. What's happening in the property market?
No worries. To be honest, George, no surprise there. We all thought it was definitely going up. In fact, I might have thought it might have gone up even higher than 0.5. A bit of positive news there. Look, everyone was aware that they're going to be paying more and more in terms of the interest rate going up, but there was less buyers initially. So the first two rate rises, less buyers at our open homes. It is what it is. We cannot control it. So real motivated buyers, people that are upsizing from the family home or have expanded their family and have a genuine motive to buy, or a school catchment, for example, as a motive to buy, they're turning up and offering at the first open still. So quality, if anything, has come out of this, and a lack of quantity as well. So less buyers, but more serious buyers are offering. So if you are in a position where you are still looking to buy and sitting on the fence, you can't pick the bottom of the market. It may correct at any stage. They may stop doing interest rate rise. We don't know what will happen next. So if you're genuinely looking to buy, it's still a good time, and there is far better purchases out there. Serious vendors have reduced their expectation to meet the market. So it's not all doom and gloom out there, George.
That's good, mate. What about finish off with some tips for some first-home buyers trying to get into the market?
Sure. Save. Make sure you have conversations with your broker early, and definitely stay in contact with agents, because I think there's some off-market opportunities that are out there if you have a good relationship with an agent, where you might be able to save even more, because the properties that are on the market are still selling and are still quite competitive.
Nice one. Thank you, Pat. Mate, you take care, and I'll speak to you soon.
No worries, George. Talk to you soon. Bye.
See you, mate. Okay, now we're going to work out how these increased interest rates is going to affect your borrowing capacity. Okay, so here we've got a borrowing capacity, and I have a few banks in here. I've kept it basic. I've got one adult, no kids, and I've just put an 80K salary. Now, if you look at, for argument's sake, just Macquarie, they were borrowing you approximately 615 grand before the rate increase. But now, if I add the Macquarie rate, it was 3.74. Now let's add 0.5, so now it'll be 4.24%. That's now down to about 584K, which is approximately 30 grand lower than it was before. So rising interest rates will ultimately affect your borrowing power. Okay, Mad family and friends, look, I know it's not the best news, but hopefully you got some good things from this video. If you do like what you see, please hit that subscribe button and turn the notifications on, because we are committed to giving weekly videos to help you guys achieve your version of financial freedom. And I want to finish off by saying one thing, guys. With rising interest rates, mortgage stress is real. If you or any of your family are experiencing mortgage stress, we've done a video. Please watch it where we talk about things which can help you combat it. Thanks for watching, everyone. Have a mad day.